Hello and welcome to day 20 of the 30-day money course. And today I'm going to be asking, what type of investor are you? Do you know? Okay, even if you don't know, we'll find out by the end of today's video. I'm Elizabeth Booker and I'm the founder of Wealth from Little. I'm also the hostess here on this 30-day money course. So back to my question, what type of investor are you? There are three main types of investors. And you might have heard of these terms before, but they are active investor, passive investor, and inactive investor. So what do they mean? What do those terms mean? Active investor, let's go there first. So as it kind of sounds, an active investor is one who's actively investing. They are constantly manipulating their stocks, their portfolio, their funds to ensure that it's, creating profit for them. You can find them like they think they are, most of the time they are the types of investors that are involved in day trading. So you would see with a day trader, they are consistently selling and buying stocks in minutes, in hours, usually within short periods of like a day or a day and a bit. And so it's a very active type of investing, and therefore they grow their money based on the activity that they do. Now, how do you win as an active investor? You should be able to understand what you are doing, understand what you are investing in, and be able to understand how to invest and how to control your emotions when you are investing. So research is a really big part of that, being able to research and understand what you're researching, understanding what to do when the stock is dropping and what to do when the stock is rising. Those are really key things, and most especially managing your emotions. Those are really key things to be able to do if you are an active investor. Okay, the second type is passive investor. Now, with passive investing, if you're a passive investor, you would look into understanding again and reading. You always have to understand anything you're investing in, right? But on this scale, you don't have to learn it over and over. So you learn it once and then you decide to replicate that through a process. For example, we can see this when you're investing in index funds. When you're investing in index funds for the long term, so that is long-term investing in index funds, you understand what the index fund that you're investing in, you understand why you're investing in that index fund. You do the research on, understanding the key information about that fund, the key information about the companies involved in that fund. And then you understand how much you can afford to invest on like a monthly basis, ongoing. Remember, we're thinking about the long term. You understand how much you feel that how much return you would get on that investment based on 7% at worst case, or maybe slightly more if the stock market does better. And you know the risks. If the stock market should fall, what would you do? You keep on investing because it's long term. If the stock market should rise, what do? You keep on investing because it's long term, right? And because you're investing for the long term, it rides out the wave, it rides out the ups and the downs. And because of that, it's very passive and it creates a form of passive income, whereas active investing creates a form of active income, right? So passive investing creates a passive income because you do it once. You can you can set your bank to do direct debits every month, so that so every month a portion of your savings is always going into your investing account, and it's just not automatically investing and reinvesting your profits and your dividends for you for the next couple of the next decade or so that in the future you now have this huge portfolio that you can start to draw down of. That means that you can start to take money out of as when you need it, like when you need it each month or each year. Okay. And the last type of investing is inactive investing. And inactive investing is exactly kind of how it sounds. You're not doing anything. So this is for the kind of person who does not necessarily want to do any research. They don't want to learn exactly how to do it, or they don't feel they are best equipped to manage their own money. And so they would rather pay a professional, really smart professional stockbroker, a fund manager to help manage their money. Now, the difference here is that with that type of investing, you are going to still get roughly the same results as someone who is passively investing in index funds, but you are going to be paying a lot more because you're going to be paying management fees to the company or the person who is actually doing the work for you. So that's the main difference. So in the long term, you would see that the amount of money you could potentially have built, the amount of wealth you could potentially have built for yourself via that portfolio would not be as much as you would receive, because you'd have put quite a bit of it towards paying fees, if you get what I mean. Okay, so those are the three main types of investing. And active investing, that's like day trading, if you've ever heard of forex trading or stock trading, those kind of things where you're trading day to day, minute to minute, hour to hour, that's really active. So it's almost like another job per se, or another income stream per se, another hustle, because it's not passive. You actually have to do the work, understand it, and do the work of making those trades and receiving, making those trades and making those decisions on an hour to hour, day to day basis. With passive investing, especially if you're investing long term in index funds, then you would just, put some money in, leave it on automatic, and that would just happen each month. So now that you know the difference between all three, right? I want you to, based on the time that you have available, based on your aptitude towards learning, and based on your preference, what type of investor do you think that you are? Overall, we do have to always keep learning if we want to earn more. And the idea doesn't necessarily mean, you're not necessarily limited to saying, oh, I'm a passive investor, oh, I'm an active investor, and then you can't be any other type of investor. You can have multiple streams of income, and therefore you can be multiple types. You have, multiple investor types, tongue-tied. So you can decide that I am going to put a portion of my savings towards passive investing, a portion of my savings towards active investing, and allocate a portion of my savings towards inactive investing. For example, I didn't mention an example of inactive investing. If you invest in mutual funds or invest in some pension plans, are actually inactive investing because they are taken care of by people, smart brokers, smart managers, fund managers, who take care of that fund for you, and they receive a salary because of that service that they are doing for you. So think about what type of investor you are, and maybe what other type of investor you would like to be in the future, and understand what is required of you so that you are a great investor. Okay, that's it for day 2. Email me again, day 20 done, when you have done this assignment, which is to think through and understand what is required of each of the different types of investors. Have a great day and see you tomorrow.